Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retiree. Today we're going to talk about the dreaded target date funds. Thanks to CNBC's recent article, it highlights the need to discuss the importance of using target date funds correctly. So we'll do that coming right up. As always, should you hear something in today's podcast that causes you to want to make some changes, to make decisions, to change some things about your investments, for example, especially considering today's topic, I must urge, very much urge, that if you hear something today that causes you to want to take some action, while we are honored by that, we must insist that you work with the appropriate tax, legal, or in this case, especially an investment professional who knows your specific situation prior to making any changes. This podcast should not be construed as specific tax, legal, or investment advice. Okay, Greg. I practiced this name so many times, yet here I'm ready to go to say it, and I can't. Yakuri? No, that's wrong. Anyway, it's an Italian name. Greg, I apologize for butchering your name. Yakirchi, maybe? Anyway, I totally botched it. So much for practicing it. Many 401k investors don't use target date funds the right way, Greg headlines his article. So CNBC did produce a nice article that highlights some of the challenges that investors face when they are selecting their investment options in their 401k or 403b or 457 types of plans, TSPs, all of the above, okay? These types of plans are having more and more target date funds. The concern about target date funds is, number one, when and how should I use them? And so the first question being, should I use them at all? So I've talked to many of you. I have a little insight that Greg doesn't have, in that I talk to you listeners out there. I know what you're thinking when it comes to making these investment decisions, and should I use something like a target date fund? Here's what I hear from many of you. Number one, three things. Number one, well, really two main things. Do target date funds have higher fees? Seems like they should, right? Because they're a little more complicated. Aren't they like actively managing them? Isn't that how that works? So don't they have higher fees? Well, okay, it depends on what you're comparing them to, but the short answer is, in many cases, yes. However, there is a misconception about the fees in target date funds that we should address. Many target date funds will purchase the underlying investments as funds from the same family, meaning a Vanguard target date fund is most likely purchasing other Vanguard funds inside of the target date fund. So you buy the target date fund, internally you're being diversified amongst multiple funds at Vanguard. Okay, so you would ask yourself, well, can't I just buy those underlying funds? Won't that save me some money? Well, yeah, but except that you lose then the value of a fund that is year to year adjusting its mix of the investments on your behalf without you having to think about it. The target date fund is really a convenience factor fund. The fees will be somewhat higher, generally, not always, but the value is that you're getting a little more professional management ongoing. Maybe a little cheaper than paying an investment manager who's investing specifically to your situation. So they're kind of lumping you into a group. You're getting professional management to the group, not to your specific situation, but at least it's a little bit closer and might do a better job of attending to your specific time horizons and risk tolerances. Okay, so that's some of the values of a target date fund at a high level. Now, the higher fee issue is that one of the misconceptions is if I buy a Vanguard target date fund, they buy all of these other Vanguard funds, aren't I paying twice? Don't I pay the target date fund fee and then all of those other funds have fees? Don't I pay those also? Oftentimes the answer is no. you're not actually paying double the fees. Not every target date fund works like that because of the compliance issues of telling you which funds are the good ones and which ones are the bad ones. I won't do that. So just know you need to do your homework, okay? Ask the question, whoever is running or managing your 401k plan or 403b plan or whatever kind of plan you have, they should be able to tell you whether the fund is doubling up on fees or it's only paying that target date fund fee. Okay, so you should be able to sort that out with whoever is managing your target date fund. Okay, now, there is a diversification myth that happens. Okay, so we said number one is don't target date funds have higher fees? So I think we've kind of dealt with that. The double fee issue is most of the time, not an issue, but you need to check, okay? The second thing that I hear many of you say is I don't want to put my eggs in one basket. I want to put all my eggs in one basket, right? So that's good advice, right? I can't remember exactly how it goes, but there's kind of like this joke about, the farmer, he was carrying some eggs and he tripped and fell and, he broke all the, the bag fell, the basket fell, the eggs fell out, they all broke. But if he had them in more than one basket, he wouldn't have broke it for all of his eggs. So that's the idea, is that you don't want everything to go down the same tube. So shouldn't I, if I have a target date fund, shouldn't I diversify and not only buy a target date fund, but maybe buy the target date fund plus a large cap value fund or a real estate fund or another S&P fund or something like that? Shouldn't I get a few different funds so that I'm more diversified? When it comes to a target date fund, the answer to that really is no, because the diversification myth or trap that you're falling in is you're assuming that you're not highly diversified because you're buying one fund. Now I know that, pragmatically, it might be very difficult for some of you to actually own, say, 1 million shares of a fund. Okay, or at least $1 million like in one fund, or even a couple $100,000 in just one fund feels risky. But really it's not, okay? Not in the sense of being any more risky than if you had bought 2 or 3 different funds. So the question is am I more diversified if I buy 5 funds, say an S&P fund, a large cap value fund, a small cap fund, and a mid cap fund? If I buy those 5 funds, am I more or less diversified if I do that versus buying one target date fund? Which one gives me the most diversification? The answer is the target date fund. Now, we're going to do something today that's a little unique. If you're listening to this on audio, I apologize in advance because I'm going to put some things on the screen here. And so if you'd like to see that, you might watch this later on YouTube. And so here's what we're going to do. We're going to give this a try. So bear with me. Hopefully we can pull this off. Let me take my name off here. Okay. So this is a tool called Fund Visualizer. And what this tool will allow us to do is look at a few different funds. Now, in here, I have loaded in 3 separate funds. One is the Fidelity Freedom 2020 Fund. Another is the Fidelity Freedom 2030 Fund. And then the last one is a Fidelity 500 Index Fund. So that's just an S&P 500 Index fund run by Fidelity. Now, the first thing that I want to highlight here for you is that when we go to think metrics that are important to see, okay, am I getting diversification or is the fund providing some value to me? Well, the first thing we would want to look at here is this thing called downside capture ratio. Now, this is benchmarked off of the S&P 500, and so if we look at a 1-year return on the S&P 500 versus, say, the Fidelity Freedom 2020 fund, because the Fidelity Freedom 2020 fund is assuming that someone retired in the year 2020, then we would assume that the downside capture ratio should be lower. Meaning if the stock market drops 10%, we would expect this fund to not drop 10% because it's more diversified. It's invested for someone who's newly retired. And in fact, we do see that. So the downside capture ratio on this fund is 62.8, meaning if the S&P 500 were to drop 10% and we saw similar downside capture ratios, we would anticipate that this fund would drop about 6.2%. The Fidelity Freedom 2030 fund is a 76.93, meaning if the S&P dropped 10%, we would anticipate that this fund would drop 7.6%. The Fidelity fund itself that's tracking the S&P 500 is basically dropping dollar for dollar, 100. So if the S&P drops 10, we would expect this fund also to lose 10% because that's what they're doing. They're tracking the S&P 500. Okay, so we see that there is value. We're getting some risk management by using these types of funds. Now, let's go to some other charts. The thing I said earlier is that many of these funds will purchase internally their own funds. Okay, so the Fidelity funds here that you're seeing in this list, the holdings for the Fidelity Freedom 2020 fund, that's this column here, and the Fidelity Freedom fund over here, that's the 2030 fund, is this one here. And then FXAIX, which is the S&P 500 fund, you see it's actually holding individual stock positions. Now, eventually these individual stock positions show up in these other funds. For example, I did look earlier to see if in this large cap value index is, say, Procter & Gamble in there. Yes, it is. Okay, so there's going to be overlap. Okay, overlap meaning how much of the fund is similar between the S&P 500 and these funds. But the difference is there's a lot of additional funds and positions in addition to just your stock funds. And so you see here there are a lot of different positions here in these Fidelity funds. I asked the question earlier, am I more diversified buying 5 funds or buying a target date fund? You can see that by the sheer number of funds internally in these target date funds that I am much more diversified using the target date fund than I am using the 5 individual funds. Now, whether that's good, bad, or otherwise, how does it match your risk tolerance? How does it match your investment goals, your investment experience? Those are totally different questions. But if the question is, do I want to put all my eggs in one basket? The short answer is when you use a target date fund, you are not putting all your eggs in one basket. Okay? So very important to highlight that. Now, here's the second question. Do these target date funds follow the research? So let's go back here. Let's go to asset allocation. So the research around retirement investing has shown that in the year that you retire, you should have the lowest equity exposure. Now, the research variance between the low end of stock exposure and high end in the year of retirement is between 30 and 40%. 30% is sort of the gold standard, the perfect amount of stock exposure in year one of retirement. But you could have as much as 40% and you'll still be within a pretty good success ratio by comparison to the 30%. Individual investing needs and specifics around your own individual circumstance will obviously vary these numbers. But if we just follow the gold standard around highest success rates with retirement planning, we would follow what's called the rising equity glide path for retirement investing strategies. And what you would do is you would start your retirement, there again, gold standard, at 30% in stocks. What you will see here is that although the 2020 fund is assuming someone is freshly retired, you can see that the positions have 22.49% in U.S. stocks and 26.72% in non-U.S. stocks, a combined total of just over 49% in stocks. So are target date funds in line with the research around retirement investing? Unfortunately, most of them are not. I can't say for sure that all of them do not follow the research, but the majority you will find to be very similar to what we're seeing here from Fidelity. So, multiple takes on how to do retirement investing, that's for sure, but if we just want to follow the gold standard around highest success rates for retirement investing, this particular target date fund is not doing that. Now, the question becomes, why is that? Why is that happening that way? Well, I will tell you that generally speaking, target date funds are going to work fairly well for those who are dollar cost averaging or saving into funds. In fact, that's one of the reasons why we find target date funds mostly being used in individual, 401k, IRA, or not IRA, 401k, 403b, 457, employer-sponsored plans, okay? We see these funds being used a lot in those types of plans. We do not see them being used as much in say, IRA accounts and accounts that people have then rolled out and are more being specifically managed for your specific situation. We don't see target date funds used as much in that scenario. But inside of 401k plans, they can be very useful. The question is do I need to diversify out away from just a target date fund? Generally, no. If you're going to use a target date fund, use the target date fund. If you want to build a customized allocation, you need to do a lot of research and spend a lot of time learning about how to construct an appropriate portfolio for yourself, or maybe consider hiring someone to help you build that investment allocation. There are many advisors who will work on a fee basis to provide recommendations to you and help you spot check your 401k investment selections. I do recommend that you work with a fiduciary advisor to make those types of decisions if you're going to build your own asset allocation. If you don't want to get involved in all that, and you don't want to try and figure it out, using a target date fund can be a reasonable solution while you're working and saving. However, because most target date funds, and I have yet to see one that do not follow the research. So most target date funds do not follow the research. If I find one that does, I will do my best to be sure to let you know, but I haven't seen one. And so you got to be very mindful that once you get into retirement, continuing to use the target date funds may not be the right solution for you because of their failure to adhere to those gold standards around retirement investing, specifically highlighting that rising equity glide path in producing the highest level of success outcomes for a retiree, retirement investor. Okay, I will link the article to CNBC. I do encourage you to really think strongly about your investment selections and how you do this. As you are retiring and getting closer to retirement, it's an important time to review your asset allocation mix and just decide how you want to do things. Do you want to follow the research and go towards the gold standard, or would you prefer to maybe do things a little bit differently? Maybe to stick with something like a target date fund or build your own asset allocation. The key is you need to be very in tune with your finances and know what you're getting yourself into, especially when you're retired, because you don't necessarily have that income still coming in, that if your investments do poorly, you can simply maybe buy low, buy into stocks when prices have dropped. You're losing those abilities, and so you need to be very mindful and careful about how you manage your retirement investing. Again, I'll link the article in the description section. As always, we do encourage you to subscribe to our YouTube channel here, follow our Facebook page. We'd love to interact with you at future events that we put on, whether that's to see you at another podcast, a daily podcast, or if we see you at one of our live workshops, we'd enjoy doing that with you. That's all we have for today, and we'll see you next time.